theory statistics, stuff like beta, where that's our relative measure of volatility, or market risk, or systematic risk, a lot of different names for the same thing of a security or portfolio compared to the market as a whole, usually using the S&P 500 as a benchmark. So again, if you see something with a beta over 1.0, usually that's more risky than the S&P. If you see a beta under 1.0, usually less risky than the S&P. That's just kind of generally how it goes. We talked about alpha, how it uses beta to give you a gauge of how much return you should be seeing, and then measures how much excess or lack thereof you have. So positive alpha would show that you have excess returns over the risk that you're starting to take. And negative alpha would be that you are actually not returning as much as you should be given the level of risk as measured by beta. It's a very common thing for portfolio managers to measure their success in alpha. So if you hear something like a hedge fund, or a hedge fund trader talking about all the alpha that they made, that's like their whole job. Their whole job is to make extra returns that you wouldn't necessarily get in the S&P 500 for the same level of risk. So if you see somebody trying to make alpha, that's your extra returns, things on top of what you normally get in the market by just risk. We talked about R squared as well, which is basically an explanation of how much of the volatility or price movements that you're seeing can be explained by a benchmark that we're comparing to. Again, usually that's your whole market or S&P. That's just kind of, most of these statistics, it's generally accepted that we use the S&P as a reference point. Sometimes you can use other things as a reference point, so if you want it to be more within the category. So if you were talking about bonds, it might not make as much sense to weigh those bonds versus the S&P, but we might look at something like a bond aggregate index. But for the most part, we tend to agree that the S&P is our baseline measure of volatility, and risk, and price movements, and all that sort of stuff. So again, an R squared of 100% means that all movements of a security are completely explained by movements in the index. And we can use this to gauge how similar our investments are to the comparable index or the S&P. So if you've got a portfolio, your R squared is like 90 and above, you can be pretty certain that when the S&P moves in a certain direction, you're going to move pretty much in the same direction. And then if your beta is higher or lower, that shows you the magnitude of which will be moving. So we also started to talk about some other risk and return statistics that aren't necessarily correlated with modern portfolio theory. Things like standard deviation, which is kind of an absolute measurement of volatility, something that measures how far away we can go from our average measured return on a standard basis. So it kind of gives us, again, the idea of the overall volatility of a given investment. So if you've got something that has a standard deviation of 10%, you might see it go 10% above its usual returns or 10% below. If you see a standard deviation of 30, obviously it's the same thing, up and down 30 from that average. And returns obviously can fall outside of the standard range. I mean, the S&P 500, I think, has a standard deviation of like between 15 and 20 on average. Usually 17. Yeah, something like 17. But you can see years that it returns 3, or it returns negative 10, or negative 20, or shoots and has like a 50, 60% year. So again, standard deviation just kind of averages those numbers together and gives you an idea of, on a normal basis, where we would be. Mean return, really just that expected average return, looking at all the historical data, all the stuff that we've looked at before. What can we expect from our investment going forward? And again, it's not going to be a guarantee of the returns that you're seeing in the future, but just some kind of rough estimate of what a security might do on a long-term basis or on a year-over-year basis. So really, it's just by taking all that historical data and getting an average, however it is that that's calculated. And if you don't have a lot of time that this is measured over, outliers can significantly skew that. So an example of that could be something like Tesla. If you were to look at the overall volatility of Tesla, the overall mean return, it might be a certain number. But if you were to shorten your view span and look at only those few years where all it did was basically go up for a few years straight, you might really significantly skew your mean return and have a different idea of what you think is going to happen in the future. So lots of data is really crucial to most of these measurement points because it gives you, a better idea volatility of this investment, not regarding any outside factors. So we're not looking at anything else. We're not looking at any other markets. We're just looking at, based on how volatile this thing has been in the past, how much extra return are we getting on top of that volatility. And then we talked about some bond-related stuff, like effective maturity, which is basically just, on average, how long do bonds last in your portfolio, when accounting for all the different prepayments, puts, adjustable coupons, callable options, stuff like that. And then you've got your average effective duration, which on a super basic level is just a measurement of how sensitive your bonds are to interest rate movements. So if you've got a longer duration, it's more sensitive to when interest rates go up and down, because like we said before, if you've got something that pays 1%, but a new bond is paying 5%, nobody's going to want to pay the same price for your 1% bond as they would for a 5% bond, because they just do losing money. So if there's a big difference, your bond will be cheaper or more expensive, depending on the relationship between the two. We talked about credit rating a little bit, and really the important thing to know is everything above here is what's considered investment grade, and everything below is considered junk, or when they don't want to make it sound as bad, high yield. It makes it sound a little bit more enticing. But generally, these are going to be much more risky. There's going to be a chance of the debtors defaulting on the loans. Up here is generally considered safer. You're not really too worried about that. But obviously, interest rates will be higher here, and they'll be lower here, just because they need to compensate you for that extra risk that you're taking. So, if you can make it through with those junk bonds, you can make a lot of money on interest, but you got to be aware of the risk that you're taking. So, that brings us to what I want to talk about today. A lot of the times when we're teaching, or when other advisors, or even people who have taught me in the past, when they teach about investing, they like to start with investment objectives and risk tolerance so that you can sort of define where you are, then use the other information to teach you how to pick what you want for your investments. I prefer to do it kind of in the opposite way, because this information is kind of like, it's helpful, and it's really helpful to deliver to an advisor, but if you're doing it yourself, it's difficult to know what to do with this until you know how to evaluate funds and stocks and bonds and all those other things. So the reason I like to sort of do this after we've learned how to evaluate an investment is it kind of makes it click for you and go, oh, that's why beta makes any difference at all. Because now I know that this is more volatile, and I can fit that into my investment objectives and my risk tolerance. So that's just a little bit of reasoning why I like to kind of go backwards. But what we'll do today is we'll just look at a couple different examples. We're going to simplify things way down. We're not going to worry about super complicated metrics. We're just going to simplify down to equities and bonds, basically, and look at how those balances fit within different objectives and different investor avatars, for example. Yes?
Is an avatar like a profile?
Pretty much, yeah. Yeah, it's just like an example of a person.
Okay.
Kind of like you could, like we would be very different avatars. For example, since you're much closer to retirement age, you would be much more focused on things like retirement income. You might be focused on tax savings. You might be focused on capital preservation, versus me, as a much younger avatar, would be much more concerned about overall growth and riding that wave up to the sky. So, we'll start with investment objectives as defined by our parent company. These are really the jumping off point that can kind of give you an idea of what each of these different things mean, and we can use those to determine where we are, what our likes to have some income from their bonds and other things like that, but they also might be willing to use things like dividend-paying stocks and other value companies that might pay out dividends as another means of generating some income. Now, granted, those assets will have some more volatility, but that's something that this person is willing to take on, as well as a little bit of a growth component. So your companies that don't pay dividends but are looking for upward growth, something like NVIDIA that you might have heard of lately, things like that. Moving up again, we get to growth and income, which sounds shockingly similar to balance, but I don't really find my parent coming out the definitions. I just roll with it. This investment objective means that the investor seeks investments that primarily focus on the growth of the portfolio, with some of the portfolio being allocated to income-producing investments. Growth and income is again pretty middle of the road, but kind of leaning on that side of equity growth and building the portfolio up. So this might be somebody who is not exactly at retirement age, but they might be looking for some stability in a portion of their portfolio as they're getting closer, and maybe something that they can start moving into when those growth assets grow, and they can start moving over to those income. So again, it's very similar to balance, but they just lean a little bit harder on the growth aspect, on the overall returns, trying to grow their portfolio. Growth starts to get a little bit more aggressive. This investment objective means that the investor seeks investments with the majority of the allocation being allocations comprised of investments that have a focus on growth of the portfolio with little to no emphasis on producing income. So you can basically think of this kind of person as somebody who doesn't really care for cash flow. They don't have a need for it. They're just looking for a lot of growth. That would be somebody like me. That would be somebody like me who has a lot of time. So, for example, you could look at my retirement plan. Because I'm so young, first of all, anything that comes out of that would be taxable and penalties. So there's no really good incentive for me to start pulling money out of that account. And I've got a lot of time until those penalties drop off. So I want to use that time in order to see a lot of growth in my portfolio. Cash flow doesn't matter to me. What matters to me is that the securities are growing in value and we're riding the overall wave of the stock market. So I'm not worried about having bond funds. I'm not worried about having value funds. I just want growth, technology, stuff that's going to really start moving over time, things that I am allowing extra volatility in order to get that extra return. Because I'm going to see years where my portfolio is really bad because it's aggressive, because we are more strongly allocated to these growth stocks. We're going to see more volatility. We're going to see more bad years. We're going to see more good years. But I'm looking to get all of that time behind me, what we talked about before, all of that long periods of time that helps us average and smooth out returns as we reach our final objective, our time limit. Maximum growth is pretty much the same thing as growth, but just crank up the switch, like we just go all the way there. This investment objective means that the investor seeks investments which may consist of the entire portfolio in equities and are very willing to invest in securities that carry a significant degree of volatility beyond traditional equity market indices. So this last part is kind of important, but kind of keys you to the difference between the two, beyond traditional equity market indices. Because somebody in growth is probably going to be focused on your S&P funds, on your NASDAQ funds, total market. While they might not have any bonds, they're also not taking extra risk. They're not dumping everything into small caps. They're not dumping everything into tech funds. They might still be well diversified across the market. But somebody like this would be willing to forego those less volatile returns and just throw everything at the wall and see what sticks. Somebody might be in really, really strong tech, growth, small cap, mid cap, all these like really, really volatile investments, things that have a standard deviation much higher than the market. So, like we mentioned before, something like a total market might have between 15 and 20% standard deviation. We might be looking for something that goes 20 plus, 30 plus, those super small companies that are very volatile, maybe even healthcare or technology, a lot of those things that we mentioned before. So that kind of gives you an overview of all the different investment objectives that you might have. Now, we're going to now go into risk tolerance, which might feel like it is the same thing, but at the same time, these two pieces give you an overall picture of what it is that you're going to be investing in your portfolio in. yourself a lot of time for those assets to get their average returns, for them to really do what they're supposed to do over the long haul. So if you don't have the time to wait, if you don't have the decade or decades to wait for these to get to their eventual, sort of goal, then it's not really worth it to invest your portfolio this way, because then you might be in a situation where, again, today you have enough, but with a bad stock market crash, you might not. So you don't want to put yourself in a position where you have the possibility of losing out on what's needed. So moving forward into risk tolerance, generally I like to think of risk tolerance as sort of the emotional component of what we just talked about. So all of the previous things that we might have talked about really just come down to numbers. It comes down to what you need to do to actually satisfy your goals. But when we talk about risk tolerance, it's more of like, how much of that are you able to sustain, like emotionally, before you start, whether you start having panic attacks or really just you can't comfortably look at your investments. Because I mean, I've seen that time and time again, where we bring clients in, we get them allocated properly for their needs. If they just stuck it out, they would be okay. But if the stock market has a particularly bad day, and we get that phone call, and they say, "Get me out." No matter what we say, they're unwilling to stay in. They sell at the bottom, and then the market rallies, and guess what? We get another phone call, and they want to get back in. And they're not willing to see that volatility. They're not willing to see it run without them, and they're not willing to see it drop with them. So it's very important to understand what you are actually willing to tolerate in terms of volatility and risk, because if it's something that's going to keep you up at night, or if it's something that's going to force you emotionally to change your plan and drop out of what would have gotten you to your goal, then it's too much. So the conservative risk tolerance indicates that the investors are not willing to tolerate large market fluctuations and is willing to forego significant upside potential to achieve this goal. Very important to understand that even if you don't want to feel those large fluctuations, you also have to forego the upside. Risk and return is directly correlated every single time. Unless your alpha is off the charts, you have to take more risk to get more return. That's just how the game goes. The investor wants the portfolio to provide them with an income stream to meet living expenses. So this sounds a little familiar to some of the things we just talked about, right? We talked about some of those objectives. This might line up pretty perfectly with current income or maybe a balanced fund. They're more concerned with protecting principal than growing the portfolio. Again, something like you just mentioned, with that retirement scenario, they might be a little bit more concerned with actually protecting the capital that they have rather than growing it for some other need. But if you have assets that don't really have a purpose in your life, or are really meant for a beneficiary or something, you might not need to have such a conservative risk tolerance.
This last week, the market's been fairly volatile, right? This is a great time to reassess whether or not you're comfortable, because we're at a somewhat of an all-time high. And if you got money that made you uncomfortable in the last week, maybe it's time to take some money off the table, buy some CDs or bonds or something else. But if you don't, and the market tanks, and then you're even more stressed out, then that's worse. So just kind of, the first time we lost control of our car, but didn't get in an accident, and we said, I'm going to slow down. This is a time to readjust that thought process, if at all, or if it does tank a lot, is short-term, intermediate, long-term layers allow you not to worry about the part that's down a lot, but just rethink things. Not that you shouldn't be, because you can always be holding money for future generations, but this last week gave us a good reassessment.
Yeah, because I mean, these weeks and these days can happen really at any time. So even if you think that the stock market is just going to keep doing what it's doing, it's going to keep running higher and higher, you got to be willing to understand what those intense days are going to look like and how they're going to feel. Because, I mean, I've said it before and I'll say it again, there are people who, they'll see the volatility, they'll see the crash, and then they'll make a drastic change, they'll make a drastic measure that actually takes them out of the game. And as soon as you get out of the game, you run the risk of losing out on the good days. I forget exactly who published this study, but it was something along the lines where if you were to miss out on 10 of the best investing days in like the last decade or 20 years, I don't remember what the time frame was, but you would miss out on like most of the returns. You would miss out on like 50% to 70% of, if you just missed out on the 10 best days, your portfolio would do significantly worse than if you held through every single bad day. So it's really important to understand that if you're going to take risk, you have to sit with it. And if you aren't willing to take risk, be able to admit that both to yourself and to your professional so that you can create a plan that works for you. So the investor with a conservative risk tolerance would choose investment objectives of current income or balanced, exactly like we just talked about a second ago. For somebody who might already be retired, would probably be in here unless they just have more money than they need, in which case they might step up to something like moderately conservative. We have moderate in the middle, and then we have conservative and aggressive on either side, and then we like to have some spots in between. So the moderately conservative risk tolerance indicates that the investor can tolerate a bit more risk than the conservative investor, but are still averse to large short-term fluctuations. So this might be somebody who's willing to have a small bit of equities in their portfolio. They're willing to take on a little bit of that growth potential because possibly their time horizon is still 10 years and they still are willing to see some of that growth to help feed their income streams, but they're still not willing to, bet the house on the stock market and expect for it to keep going up for a long time. So they want to be protected somewhat from large downside market movements, and are not willing to fully participate when the markets rally upwards. So again, it's very similar to the previous one, where they're willing to not feel the large downside by giving up the large upside. Now, because they're willing to get in a little bit, they're going to participate some of it, and they're going to get some of that upward movement, but they're not going to get all of it because they're not fully invested in equities. This investor understands that the portfolio will still fall when markets decline, but want to be somewhat protected. So they might just want to be in a majority of things that aren't going to be flying up and down when the market's in panic mode or when things are really volatile. But they're willing to see maybe a 5% decline or a 10% decline on particularly bad days. The investor with a moderately conservative risk tolerance would choose investment objectives of current income, balanced, or growth and income. So I would say that this is actually probably the most common risk tolerance that I see from a new client or from existing clients, mostly because of the age range that we deal with, where they're close to retirement, a little bit into retirement, or fully retired. This is going to be some of the most common, where they want a lot of stability, but they still want to participate in the stock market, and they still want to see a little bit of growth over the years, especially if they expect assets will outlive them and will pass to a beneficiary like their children, grandchildren, etc. So as we move up the chain, again, one more time, we hit that middle ground, that moderate risk tolerance. So this risk tolerance indicates that the investor is in a middle of the road category, pretty much smack in the middle, where they're willing to have some volatility, but they also want to have some safety. And this kind of is pretty much, I would say this is the risk tolerance that we used when we built our sample portfolio a few weeks ago. So when we actually put together that portfolio, we had a standard deviation of like 11%. The beta was like 60 something. This is pretty much that risk tolerance that they would be sitting in. It's pretty balanced. It's maybe 60% equities, 40% bonds. It's really kind of that middle of the road where on a standard basis, this is where most people are going to follow in an overall sense, not just people from our firm, but people in terms of maybe middle of their work career or starting to approach and think about retirement, but not close enough that they need to cut all risk off. So they want good returns, and they know that they must take on more risk to get those returns. And the portfolio may hold a wide range of asset classes ranging from short-term bonds to high-risk stock funds. So again, this kind of person has a little bit of everything. They have both sides of the equation. They have those stocks that we're trying to get some growth on, and they have those bonds that they're willing to have some safety on and just get a little bit of interest for it.
And if the worst case scenario happens, if the market crashes big time, you you have your bonds that usually don't drop as much. So
Yeah.
long term you're comfortable, short term you have a backup, right?
Exactly. So it's kind of that thing where if you're taking a little bit of income, but you're also looking for a little bit of growth, you have those bonds that you're willing to be able to pull from that don't see a lot of volatility. And obviously for low volatility, we recommend short bonds because we saw what happened with long term not that long ago. They just hit the floor for a little bit there. But you're also willing to have some of those stock funds where you see them go down 10%, you see them go down 20%, but you understand that you're not using them today right now, so you're willing to give them time to recover and go on past what we're expecting. So the investor knows that they will lose money if markets go down, to participate in gains when the markets are performing well. So again, you're basically expecting to see and participate in what the market is doing, but maybe not to the complete full extent of 100% equities or just having a single S&P 500 index fund. The investor with a moderate risk tolerance would choose investment objectives of balanced growth in income or growth. So again, this could be a person where if I were to have them in a growth portfolio, if what they were mostly concerned about was growth, but their risk tolerance is still moderate, I may choose stock funds that don't of a standard deviation or a beta, because we could look at a tech fund that might have a beta of 1 or 1.1 or 1.2, and that could be more volatile than the market. And if they are focused, if they are focused on that and they have more aggressive risk tolerance, that might be okay. But this person might not want to see as much of that. They might want to be in more value stocks. They might want to be in more dividend-paying things or super broad market indices. They might just want to be following the general trend and then have some safety in short-term bonds on the side. So as we move up again, we get to moderately aggressive, and this is when we start getting to risk tolerances that would be generally something that a younger person would take on. Somebody around my age, maybe even a couple years older than me, and definitely those younger than me. So this risk tolerance indicates that the investor wants to outperform the stock market indices when the market goes up, but are aware of and accept the fact that the account will likely be down more than the market indices when the stock market performs poorly. Now, personally, that's a little bit more aggressive of a definition than I would actually use for that, but again, it comes from our parent company, so it's what we're using. The investor is willing to accept more risk than the average investors for the potential of greater returns. And this person would choose investment objectives of growth and income or growth. So again, because that's a little bit more aggressive than what I would say, I mean, I don't think somebody in the growth and income objective would want to have higher risk than the indexes, because where's your income going to come from? Those value funds are not going to be more aggressive than the index, but your growth funds may be. So personally, I don't see this person as more aggressive than the market. I would probably see this person as about as aggressive as the market. That's where I would put this person. But again, they're focused on that growth and income or growth. So this is something that you would not do if you were retired. You would not be just about to come up on retirement, and this money is what was going to be funding that. That's just not something that you would use. We move up all the way, I think we actually have one, yeah, okay. We're on the second highest risk tolerance. I would say that the speculative kind of falls outside of the normal of what you might pick, but this is probably right about at the top of what somebody would want to see. So the risk tolerance indicates that the investor wants to substantially outperform the stock market and are willing to accept the higher degree of risk associated with seeking returns that outperform. Now again, when we say the stock market, we're generally referring to S&P 500, or we're referring to total market funds, which all kind of have very similar returns. But this person wants more aggressiveness. They want to see bigger returns. They want to see, like, this is like how my 401k is allocated. My 401k is allocated really, really aggressive. It's more aggressive than the overall stock market. And on a bad day, my bad days will look really bad when you compare it to an S&P fund or you compare it to a balanced investor. But I'm also willing to wait that out so that I can have more good years, not miss out on those good years or good days, and be able to see, hopefully, a much more significant return than if I were to just hold something like a total market fund. So this investor is very aware that a similar level of outperformance of when markets are performing well can negatively impact them when markets are not faring well. So again, that's just kind of like a reference to standard deviation and beta, where the more we can go up, the more we can go down. That's the name of the game. Again, the risk and reward directly correlated. The more you have of one, likely the more you have of the other.
And in your case, you can dollar cost average once a year, once a month.
Exactly. So like basically the idea there is, because it's my 401k, that's something that I'm deferring my income into, that I'm writing off the taxes now, so that I can invest in these really, really aggressive growth funds and expect that they will shoot higher in value over the long term. And I get to just keep buying in, and if markets do poorly, I get to buy more and more of them with the same amount of dollars, and hopefully really have a nice, strong foundation that can grow strongly over time. And again, not somebody who's close to retirement, not somebody who's even thinking that they're close to retirement wants to be allocated this way, just because that high level of risk, again, could really impact the amount of capital you have to work with moving forward. So they accept a high level of risk with the potential for greater returns. The investor with an aggressive risk tolerance would choose investment objectives of growth or maximum growth. So this person's not looking for income. No dividend stocks, no bonds, no T-bills, no CDs, none of that stuff. We're not looking for that. This is somebody who's looking to stay in it for the long haul and really get those long-term returns that these more aggressive funds can produce. Then we get all the way to the most fun, that I pray not a lot of you are invested this way, the speculative risk tolerance. So this risk tolerance indicates that the investor is comfortable with the absolute highest level of risk and the highest average probability for loss of initial investment value in exchange for higher potential to profit from an anticipated price move. So obviously this person, all they're interested in is maximum growth. And the people that I would generally put into the speculative category, people who like to trade options, people who like to trade futures, cryptocurrencies, all those really, really high risk assets are the things that I fit in here. This is sort of something that we almost never deal with. Like, this is not an investor profile that we tend to invest for, just because we are not really comfortable with putting people into a risk level that high. We might get too aggressive, because we might have a beneficiary account, we might have a young person's account, or just something small they don't really care about that we're willing to get really aggressive on. But speculative is something that's a little bit out of our professional reach, and that's something that we like to leave to all the aggressive speculators on Wall Street.
Are those so-called leverage funds like that?
I would say so, yeah. Leverage funds are a very difficult thing to quantify and to categorize, just because of how they work. Because a leverage fund isn't necessarily just, I'm always going to see 2 times or 3 times the market. You're going to see 2 times or 3 times that particular day. And so it doesn't tend to average out in the same way. It would be one of those things, a leverage fund is really like maximum a week-long trade. It's something difficult to hold on to.
When you look at the charts, they crash and you almost lose everything.
Yeah.
But if you did it as a day trade and you hit it right,
then you could make a lot of money. But then if you're getting to that, if you're going to day trade like that, I don't know why you'd pick a leverage fund. You might as well do options or futures, where you have a lot. It's a much higher liquidity. It's probably better risk to reward ratios and stuff like that. But again, day trading is not something that we advise on, because it's a completely different skill. It's a completely different method of trading. If it works for you, it works for you, but that's not something that we're here to teach today. So moving forward, we're just going to look at a couple different example portfolios, and I want to remind you that these are way simplified from the things that we've talked about. Because obviously we like our short-term bonds, we like to stay diversified, but the way that these are represented is simply by using an S&P 500 fund and a bond aggregate fund. And bond aggregate just means you take everything and you kind of average it out to one representation. So SPY is our S&P 500 fund, AGG is our bond aggregate fund. So each of these have different levels of risk, and we're just, for the purposes of today, we're going to assume that stocks are high risk, bonds are low risk. Even though you can have high risk and low risk stocks, and you can have high risk and low risk bonds, we're going to simplify just the view that you're looking through to expect that stocks are the high risk, bonds are the low risk. So we've got something that goes all the way from a 100-0 to a 0-100 in about 20% increments. So over here on the left, we'd have 100% stocks, no bonds, 80% stocks, 20% bonds, 60% bonds, or 60% stocks, 40% bonds, and then the opposite going all the way down. So it kind of gives you a simple idea of how you might be allocated. So moving on to investor example 1, we're going to start looking at some different avatars and some different people with different objectives that we might be looking for. So this investor is retired. Pension pays for about 70% of their expenses. Most of everything is covered, and distributions from the retirement account pay for the remainder, plus a little bit of entertainment and travel. You know, he's retired. He deserves to have a little bit of fun in his life. This investor desires to have some of their assets left over upon death for beneficiaries, so they might have some kids that they want to take care of, and they have a risk tolerance of moderately conservative with an objective of growth and income. So with all that data in mind, it might be interesting to see what kind of account he currently has. So right now, he would be invested in 100% stocks, no bonds. He's got a beta of 1, a standard deviation of 16%. Now, based on all the things that we just talked about for the first part of the class, does that make sense for him? I see no. Yes.
Would it be for this type of person to be maybe 60% bonds and 40% stock, or vice versa?
Yeah, yeah.
60-40?
Yeah, so there is no exactly right or exactly wrong answer, because obviously their risk tolerance could be different, but you're right. It doesn't exactly make sense for this person to be in 100% stocks for a couple reasons. One, if you look back, he has a risk tolerance of moderately conservative. An all-stock portfolio is not moderately conservative. If he had some other giant thing on top of that, that might be, you know, if you had a bunch of bonds in a different account, or just had a ridiculous amount of cash sitting at the bank, maybe. But generally, if he has an objective of growth and income, there's nothing in here that's generating any income. So for the most part, if we're looking at our different example portfolios, is there something that seems like it would be more reasonable? You mentioned something between a 60-40 and a 40-60. Do you think we would generally agree on that? That seems like the right place to be at? Yeah, I see some nods. So yeah, we might pick something like a 60-40. Because if you remember that he has a primary objective of growth for those beneficiaries with a secondary objective of income, only because he's supplementing. If this was the only income that he had for retirement, if this covered everything, I would want to be more conservative, especially if I knew that he had enough assets to cover that. So this might be something with a beta of 0.7, standard deviation of 11%, kind of that middle of the road, but gives us something to generate some income with that we can pay for expenses.
We've even seen bond portfolios be stabilized by having 20% of equities, because the stocks are just simply different than the bonds. So when the bonds had a bad year, the stocks held up. So even if we want to be cautious and have a bond portfolio, having 5, 10, 15, 20% in some form of equities gives you that negative correlation, or is it non-correlated?
I would say those are kind of similar. Non-correlation basically is like 0, where they just do randomly different. Yeah. Negative would be they actually go in opposite directions. So yeah, generally, historically, it's been negatively correlated, but obviously we saw
and the opposite
recently.
Can be true if you have all stocks. At least have some bonds, just in case the market falls. You can either use that as a cash reserve or a buying opportunity. Right?
Exactly. So, when looking at this person, is there anything we could do to make the recommended portfolio even more suitable? So if the account is large enough for the income needs, like if he needs to be generating a couple percent and he's got a few $1 million, and that's more than enough to substantially fill up that rest of the income, we might be willing to make it a little bit more conservative just to match his risk tolerance better. That's not to say that a more aggressive portfolio doesn't match his needs, but a more conservative allocation might make him feel better. So if he looks at this 60-40 and he looks at the performance year over year and he goes, oh my gosh, it's really going up and down that much all the time, but he's got enough money that if we were to shift into bonds more, we could still pay that supplemental income, I might be willing to move it down a notch to a 50-50 or a 40-60, somewhere in that realm of what you were talking about, because it might still be enough to fulfill those needs and do everything that he wants to do. So that's kind of another one of those things where you can have portfolios that numerically and financially will do the thing, but you want to make sure they also line up with how you're feeling and how you perceive it as an investment. Because if it's too aggressive for you and you're going to make a change that takes you out of being able to fulfill your goal, it's too risky for you, and let's make a readjustment. So as we move on to another example, we have an investor that's in college. Their parents are paying for tuition, and they have a Roth IRA that it contributed to with money from a fast food job. You know, this could be a pretty common scenario. I hope that people my age are contributing to their Roth IRAs. They've got a risk tolerance of aggressive, so they're willing to take on a whole bunch of volatility because they're putting it into this Roth IRA. And if you know about IRAs, there's an age requirement for when you can start taking distributions from them. So she is literally forced to not take money from it unless she wants to pay taxes or unless she wants to pay penalties on that money coming out. So she's got an objective of maximum growth, risk tolerance of aggressive. Let's go for it. We want to make a whole bunch of money. Now her portfolio is currently allocated in a 60-40. It's 60% stocks, 40% bonds, beta of 0.7, standard deviation of 11%. Now, based on the things that we just learned about her, does that make a lot of sense? No, it doesn't. It's too conservative for her. Not that this isn't going to do well long term. She might have some decent returns. But for her risk tolerance and for her objectives, she's got so much more room that she can go because we don't need this protection. Because what do we need this protection for? She's in college. She's probably got another 40 years before she's going to start taking money out. We've got a few decades before we need to start making readjustments for the risk level. So, if we're looking at our example portfolios, what would you probably want to tell her to do based on what you learned about her?
Minimum maybe 20.
Yeah.
Maybe even 100.
Yeah, pretty much up here. If she likes to have something stable, maybe for buying opportunities. Maybe this is somebody who likes to invest in companies that they've heard of and they like to have a little bit of cash on the side and go, oh, I really like Intel right now, let's go buy some Intel. But you want to have the majority of that in your equities because you want to be able to take advantage of those long-term returns. Because if you have the time, take the risk. If you don't have the time, don't take the risk. But she's got all the time in the world. She's got as much time as I do. So it's really important that she takes on that risk so that she can get those further returns in the future and give her a really good chance of having a nice, giant retirement account to use for income later on. So again, like a lot of you mentioned, 100% stocks. We could drop down to 80 if she likes to move around, but if she wants to keep it simple, just buy that S&P 500 fund, dollar cost average into it every time you got a contribution, and write it to the sky. That'll be a beta of 1, standard deviation of like 16%. Objective is maximum growth, and the client does not expect to utilize the funds for at least a few decades, being retirement age, and provided they have adequate emergency funds and health insurance and stuff like that. So obviously those are also things that you want to keep in place when you're investing into a completely aggressive stock portfolio, because if you don't have any cash reserves and all your cash is locked up in a retirement account with 100% stocks, you might be a little bit out of your boundaries and you might want to stock up a little bit of an emergency fund.
That's a huge point, because if they're unemployed for whatever reason or injured or disabled, they have to come back to this. The market's going to be a problem. But if you've got disability insurance, cash reserve, a secure job, and you're investing every month, by all means, that's aggressive as possible.
Mm-hmm. So, looking at our next avatar, this person is currently looking for a new home. And they've got $100,000 saved as a down payment on the mortgage. They expect to find and close on a new house in the next year and have deposited the cash into a brokerage account for the time being. It's just sitting around. Haven't done anything with it yet, but we've got a risk tolerance of conservative and objective of capital preservation. Now, why is that? Because we have an immediate cash need. In the next year, we're looking to spend this $100,000 on something. We're expecting to put it as a down payment on the mortgage for a house because this person is shopping. So we have an immediate cash need, super low risk tolerance, objective of preserving that capital, maybe earning a little bit of interest for our time, but not risking it, because if this person were to drop down to $50,000, now suddenly they can't afford as much house, maybe they now are subject to needing insurance on their mortgage payment. It just affects a couple different things. So possibly they're trying to retain that 20% or higher down payment so that they can qualify to not have mortgage insurance. So currently they're in a 20% stock, 80% bond portfolio with a beta of 0.4 and a standard deviation of 7%. Does this make total sense for this investor, do you think?
Well, it depends also what kind of account, because if you go back, you didn't explain what kind of account he is. How easy is it?
So yeah, we're just expecting that this is in a standard brokerage account, like individual, something you could get in and out of with no problems.
Okay.
So we're just expecting that it's available. But we've got a 20/80 portfolio in there right now. 50-50? You want to take some risks, huh? So 20/80 wouldn't necessarily be the most horrible, but we also have that volatility from these 20% of stocks. There is a chance that with that standard deviation of 7%, we could see some negative returns and bring us under our starting value. We may not have that full $100,000 left to deposit. If they are able to continue saving and increase this account with contributions, that might be okay. But looking at these different portfolios, what really makes the most sense for an absolute immediate cash need? 0 to 100. And obviously, remember, we're assuming that bonds are low risk, stocks are high risk. If you were to stick them in all long-term bonds, it probably would be just as bad as if we were in like a 60-40 or a 50-50 or an 80-20. But we're just assuming for simplicity's sake that the bonds are safe. So we would want to put them in all bonds, all short-term bonds, hopefully. Something that, 0 to a year of duration. So we're not feeling a whole bunch of interest rate risk and we're just getting paid for our time. Something that has a really low chance of dropping in value before we're required to pay it out.
But in reality, my opinion would be even this is the wrong thing to be. Wouldn't it be to be in CDs and build?
No, you're absolutely right. You're absolutely right. So again, just for sake of simplicity, we're kind of assuming that the bonds are a low risk, and we're assuming that interest rates aren't changing. That's kind of just our assumptions. But yeah, in reality, you wouldn't want to be in just a bond aggregate fund because that could be just as risky as a stock fund. That's absolutely correct, and it's something very important to know. That's why we talked about all the specifics earlier, to kind of get that in and make sure you understand what risks you're actually taking. But if we were to say, swap the bond aggregate for treasury bills, for example, that might be something that's super worth it.
The Fidelity and Vanguard have treasury money markets.
Mm-hmm.
Because the CDs are okay, but you have to keep flipping them, right? So if you buy treasuries, they're not state taxable. But if you do a money market fund,
right,
you could have treasuries or
mm-hmm.
CDs, and if you don't end up buying the place within a year, you're not hurting yourself. But 2 years ago, you didn't earn anything on those, so we had to let's do short-term bonds. But right now,
yeah,
we would be picking money market funds
mm-hmm.
or ultra short-term bond funds where the volatility is not a risk. Good.
Exactly. Exactly. That's a super important point. And that really just brings you to contextually what's going on with the market, and is another reason why you have to be able to be up on these things. Because if this was all of the information that you had, you're like, I'm going to go either bonds or stocks, you might still put yourself in a position where it just doesn't match up with what the current economic situation is. So that's a really good point. So how could we make the recommended portfolio more suitable? Because of the this speaks on what we just talked about, because of the incredibly short time horizon, we'd focus on ultra short-term government securities, which provide incredibly high credit ratings and low duration, reducing the overall fluctuation in value of the portfolio. So you could really, if you know that it's going to be a year, you could buy 52-week T-bills and just write it out till maturity, get your money back, get a little bit of interest. You're not scared about those fluctuations. Or you could do sort of like a laddering concept where you have some that mature in a month, some that mature in 2 months, all stepping all the way up until your final goal. So that's another way that we could really make that the most suitable for this particular situation, by bringing all of that volatility down, looking at all of the different important things. So just because it's bonds doesn't make it safe. Volatility still applies to bonds, like we've talked about before. Credit rating impacts it. Maturity length impacts it, which will be your duration risk, things like that. It's really important to understand what type of things you're getting into, regardless of the category that they're in as well. So here's some factors that could impact your objectives and risk tolerance. There's a couple different things that could happen in life, a couple different things that could happen in your situation that might actually make you change what your objective and risk tolerance is. Because objectives and risk tolerance can be very simple if you're just looking at it overall. You're looking at your age, it's a retirement account. It's pretty easy to come up with these things, but there's plenty of stuff that can happen during life that actually can make you change. So if there's a substantial change in assets, time horizon, or cash needs, it's likely that our objectives and risk tolerance could change as well along with those. So when we look at something like a sudden cash need, let's say we're looking at a 60-40 portfolio, something that we're able to get in and out of. We're not assuming it's a retirement account, no penalties, don't worry about any of that. But 20% of the portfolio needs to be liquidated in the next year. Liquidating half of the current bond allocation would make the portfolio too risky. So we want to increase our cash allocation in order to fund the distribution in a way that when that cash comes back out, we go back to what is the proper risk. So if you're in a situation where you have this account, but then suddenly I need all of this cash for house repairs or for whatever it is, or you want to take a vacation, it's important to think about that, how that fits into your overall picture, and make sure that you are able to adjust to provide for that, as well as stay in line with your objectives moving forward. Now, receiving a substantial pension can also be something that changes our risk tolerance. So if we're again in that 60-40 retirement portfolio, maybe distributions aren't even required anymore. Maybe we got this giant pension, I don't know why it would be late or something like that, but let's just assume you've been funding yourself with retirement account distributions, and now you have this pension that's going to pay for all of your expenses, it's going to pay for anything that you might want to do, and now you just don't need the cash anymore. If you don't need it anymore and there's no need for it, what you can do is you can imagine the pension as being like a big government bond position, because it's pretty much a guaranteed amount of money that's coming to you every month, that comes to you every year, and continues to pay almost like interest. So you can use the value of those distributions and how long they're going to last to give you a present value. That's a little bit of a complicated calculation we're not going to do right now, but you can come up with an idea of how big of a bond would this pension represent. So if we were saying interest rates were maybe 5% and you were getting $50,000 a year, that's like having $1 million bond fund. That's like having this giant bond portfolio that's paying you a ton of interest. So then when you have another $1 million in this account over here, you're thinking, well, I could be kind of balanced on that. I could be 50-50. This could be totally allocated into stocks to give to my beneficiaries or just grow my assets, grow my net worth in general. So the present value of that pension can be imagined like a large government bond position, like I just mentioned, and it serves as our bond allocation. So you can then increase the stock allocations in your retirement account, because remember, we're not taking any cash from it. There's no cash needs there. And we have this giant pension that serves as our government bond position. And if we don't need to take any cash from our retirement account, we can just throw that all into the stocks and we don't have to worry about it, because all of our expenses are going to be covered. Retiring earlier than expected can also be a very, very major shift to your objectives and your risk tolerance. Again, starting with a 60-40, if you become disabled 10 years ahead of your planned retirement date and you need to retire early, like you need to retire right now, today, there's no way you're going back to work, and Social Security is not covering living expenses, and the portfolio is not large enough to suffer substantial equity losses and continue paying sufficient income. So if we are to say maybe if it were to drop by 10 or 20%, that would be detrimental and you would not be able to afford life anymore. If that's a problem, but you have enough that you were to move towards bonds and you could pay that income and fill it up with your Social Security and cover those expenses, we might want to start shifting away. And instead of being something like growth in income, we might shift towards current income. So if you are in a position where I suddenly am losing out on that time benefit, I don't have those years for the returns to average out, for those returns to become more level-headed, along in time and we can't suffer immediate losses, now we're changing to something more conservative, something that will be majority bonds and dividend paying equities. So we might still maintain a decent amount of our equity position, but we want to see something that pays out cash flow that isn't just for growth or loss. So let's go back over everything that we basically talked about today, or really go over everything that we talked about in terms of the building portfolios and how we like to manage all of that. Because there's a lot of information with all of this. There's a lot of little details that we've gone over. There's a lot of things that we've talked about. And it's important for us to refresh and be able to understand how this all fits together. So early we started with the different types of risks that we might face, both systematic and unsystematic. Something like systematic risks would be your purchasing power risk, the risk that your dollars today are going to do less tomorrow, reinvestment rate, where maybe you've missed out on other returns that you could have otherwise gotten when you were in something else. Interest rate risk, that's your duration risk. Market risk, that's just the risk of things moving up and down in the market. That's the thing that we're all here to play the game for. And exchange rate risk, something like if you have international equities or something like that, that the difference between the US dollar and whatever currency the native currency is could be quite large. So these can't be diversified away. You can't get rid of market risk. You can't get rid of reinvestment rate risk. You can't get rid of purchasing power risk. But you can manage it to be within your parameters. So that's really most of what we were talking about today. Managing that risk is by choosing your risk tolerance, by figuring out what your proper objectives are, and knowing where you sit in the overall game. Unsystematic risk, which is our diversifiable risk, things that we can bring down to such a small level that they barely impact the portfolio at all. Things like accounting, business, country, default risk, executive, financial, like all of these things are really just, most of these will be specific to the individual investment. So if I'm thinking about an executive risk, the example that I used before is if Apple hires a new CEO and they just have no idea what they're doing, they kill their market share, and suddenly nobody wants an iPhone or a Mac anymore, that stock is probably going to start tanking over time. So if I want to be in that market, if I want to be exposed to technology, I might want to buy more than just Apple. I might be willing to buy some more diversified funds, maybe just a lot of different companies, and bring it so that that single allocation is small enough to where if Apple just were to poof, disappear, it doesn't take us so far out of range that we're unable to fulfill our goals. So it's the same thing with the rest of that. Government and regulatory kind of speaks mostly to the municipal bonds, where yes, we could be all in California municipal bonds, pay no taxes on the interest, but now you are completely at the risk of the California government doing something that really screws their balance sheet and puts us at a point where maybe they start defaulting on bonds. So really, all of this is taken care of by diversifying into a lot of different things, into being into multiple different companies, and something that just you can really bring down to such a small level that it shouldn't impact you at all, which is why we like to recommend that you start with low cost, really broadly diversified index funds, because for the most part, those funds will just take care of it for you. Like a total market fund is going to take care of pretty much all of this in your individual equities. Now, it's not going to save you from market risk, but that might be why you don't put everything into that index fund. That might be why you have some treasury bills, why you have some CDs, why you have some bonds. So again, diversifiable risk, unsystematic risk, that's why you have a lot of different individual positions. Systematic risk is why you balance your risk tolerance and your objectives and find out how much of the game you want to play and how much you want to sit on the sidelines. So we moved into more of our portfolio construction theory, talking about our types of risk. We learned about lateral integration, which is basically the way that we split up the different sort of time periods where we have our short-term stuff that we can pull our cash from if we have cash needs, or things we can use for buying opportunities, etc. Stuff in the middle, our stage 2, which would be a lot of your index funds, maybe some intermediate term bonds, things where you take some risk, but you're not speculating. And then you have your final stage, stage 3, which is where you're really waiting for time to do the work. Aggressive equity funds, aggressive growth funds, that sort of a thing. You've got plenty of time. So we talked about how those work in theory, and we talked about our sort of graphical way to represent those, as well as the diversification pyramid, how we like to go from our super low cost, super broad-based stuff, and as we get more specific and more expensive, those positions get smaller and smaller. So here's another, again, just in case you don't remember how we like to stage this out. Our time frames are a little bit different on these now. You can say 0 to 5, you could say 0 to 3, 5 to 10, maybe 3 to 7, and then maybe 7 years plus or 10 years. Really, again, a lot of these numbers are mostly guidelines, and a lot of it can be changed based on your particular situation. But again, we like to start with things that can be liquidated quickly with little or no loss. Regardless of how big this position is, we like to at least have it. Pretty much every account that we manage has at least 1% in cash. One, that's to pay advisor fees so that they can pay us for the management. And two, it's there so that if there's an opportunity and there's something we really want to move into, we have cash available for that. Stage 2, we like to look at our longer term debt and a lot of index funds, things that are super broad base that would suffer a greater loss, but we are willing to give a little bit of time for those to catch up. And then in stage 3, our most aggressive, growth-oriented, things that we're willing to speculate on and stuff of that nature. And then we talked about our 3-layer pyramid that we like to use for diversification purposes, starting with your low-cost index funds, things that aren't, charging you extravagant fees to invest in, things that are giving you lots of diversification, things that, really just give you that overall broad participation. And then as we move up, go into things that are a little bit more specific, a little bit more expensive, things like sectors, utilities, and technology, and stuff that's a little bit more aggressive just because of how concentrated it is in a particular section of the market. And you might even use something like an asset allocation fund, something like a conservative or balanced or aggressive, or something like that that kind of does a little bit of the work for you. Then as we get all the way up to the top, we start to use those actively managed funds, things that are really looking for growth, things where the fund managers are willing to take extra risk in order to generate that extra return. And again, as we move up, the positions get smaller, and as we start from the bottom, these are our biggest positions. So like for portfolios that I've been constructing recently, we start with a lot of the total market index funds, because they're super cheap. You're paying I think the one that I like is 1.5 basis points, which I think is the cheapest fund I've ever seen other than Fidelity's 0 expense ratio, which unfortunately we can't use because they only let you use them natively at Fidelity. But that's like one of the cheapest things I've ever seen. I like it a lot. It gives you that general participation, and then you get smaller as you go towards the top. So we put the concept to test, and we made a sample balance portfolio. Whether it's the best portfolio or not, that's up for debate, and there's plenty that we could do. We looked at some of the things that we could do to improve it. So we looked at our basic allocation guideline, and again, I just want to keep stressing it that these are sample numbers. These are like a place where you can start, a place where you can really just kind of like get a feeling for what might be a good start, and then if you look at your situation that calls for something different, you can adjust those numbers a little bit more. So we created a sample portfolio with about $100,000, and we created what was relatively balanced. In our stage 1, we've got things like some short-term bond funds. This would be a very inexpensive short-term bond fund, another limited-term bond fund, and then a more managed income fund, maybe to give us a little bit of extra interest. As we moved over to our stage 2, we got like our total market index fund. We've got some I think this is a value fund, and we have that moderate asset allocation fund. I believe that's from, what company does AUM and AOK in those? Is that iShares? Okay, yeah. So you have your iShares funds where they will basically create the balanced asset allocation inside of the portfolio. So if you really wanted to do very little work, they will do it for you, but you got to keep in mind that they might use longer term bonds that you might be comfortable with. So it's always important to know exactly what it is that they're doing. And as we moved over to stage 3 for our more aggressive stuff, things like QQQ, our more aggressive index, something like VO, which I believe is a Vanguard Growth Fund or something of the sort, and some more aggressive, more expensive. So this, I believe, was a really high cost mutual fund that we didn't want to have a lot in because we don't want to lose a lot of returns to fees. This ends up with an average expense ratio of 16 basis points, which for me is right within range. I like to go anywhere between 15 to 20, and I'm willing to stretch up to 25 if I feel there are some funds that are worth it. But I just don't see the point in paying 60, 80 basis points like I see a lot of advisors putting clients in, because it just seems like the returns end up being average and you end up paying a greater fee for what? For brand names? I don't think that's necessarily worth it. Now, this is only measured over 3 years. The 5 and 10 year look a little bit different, but that fits in pretty closely with our balanced, moderately conservative to moderate portfolio. So we talked about evaluating investments with Morningstar. We learned a little bit about modern portfolio theory concepts on a really basic level, because the most advanced stuff I don't even understand, and how they appear on a Morningstar report. So we analyzed each of the metrics and how they appear in practice, how you would actually practically use them. Things like beta, alpha, and R squared that we went back over in the beginning. Are there any questions on any of these measurements, or are we understand these pretty well? Okay, good. That means that I explained them well, so that's a good sign for me. So again, kind of going over the beta being our relative measure of volatility compared to the market, being the excess returns that we would get when using beta as our risk measurement. So again, just explaining that one more time, we use beta to tell us how much we should return, and then alpha lets us know how much extra we got, if we got any at all, or if we actually lost returns that we might have been expecting to get in the year.
The mistake I always make with beta is I just assume I'm comparing it to the New York Stock Exchange, and I may look at a fund that's comparing it to a different index. So I'm thinking, oh, I got a fund that has the risk level that I want, but you got to make sure that if you're looking at the fund and they say beta, what's it comparing it to?
Yep.
S&P 500, one-on-one, that's as risky, but it could be comparing it. So I get lazy and I don't look at that.
Yeah, so that's another one of those reasons why you might be interested in something like standard deviation, because it gives you a more absolute reference of what that risk is, of what the volatility is. You might have a beta of 1, but then you see that the standard deviation is only like 5%. They're probably not comparing it to the S&P 500 fund.
Yeah.
So that's one of those moments where it's helpful to understand both relative measurements, but also absolute measurements, like we talked about right after this. So R squared, again, something where we can estimate how much of the movements can be explained by the benchmark that we're comparing to. So if you have a fund that R squared is 100% and they charge a big giant fee, like 1% or something like that, you would look at that and go, well, if all the returns I'm getting are explained by the S&P, why am I not buying the S&P and paying like 1/10 of the price? So that's one thing that you can use to help evaluate whether you're actually paying for something that's worthwhile or not. Now, obviously, you can also have stronger returns with a really high R squared, but again, all of these things together can help you kind of evaluate your securities or funds or portfolio as a whole. We talked about some more things, the more absolute measurements like standard deviation, mean return, and Sharpe ratio again earlier. Stuff like standard deviation, which measures the dispersion of a data set relative to its mean. So basically that means if on average we return 10% every year, but we also have a 10% standard deviation, on a most normal year, we probably could see all the way up to a positive 20% or all the way down to a 0, which is 10% away from that mean return of 10%. So the mean return being the expected value or mean of all likely returns of investments comprising a portfolio, usually by looking at all the historical data and averaging out to a yearly number that we might be able to expect. Sharpe ratio, again, similar to that alpha. It's showing us our excess returns, but instead of doing it on a relative basis, instead of comparing it to something else, we're just looking at the volatility, the absolute volatility of whatever it is that we're looking at and seeing if potentially we got some extra returns this year, which usually would be explained by an outlier year. So if you have something that returns 10 to 15%, but this year it did 30, your Sharpe ratio is going to look really strong for the 1 year because you had a year that was outside of that average amount and you have a really strong excess return on top of the known volatility. So we also learned how to assess the risk of bond holdings in funds and portfolios, which is another thing that we went over earlier. We looked at average effective maturity, something that really just, again, tells us about how long the average bond in our portfolio lasts. So if we're looking at a fund where we have some mortgage-backed securities, we've got some government bonds, we've got CDs, all this kind of stuff, it takes all of that into account, possibly the expected prepayments. So on mortgage-backed securities, a lot of the times you can have somebody pay off their mortgage early, and now that debt instrument doesn't exist anymore because they've paid it off. So that's a possible thing that can happen. Or if you have something like a callable bond, where the issuer has the option to call it away, if interest rates have dropped in the overall market, they're paying you 5%, but they could pay somebody else 1%. They're going to call it away from you, give you your money back, and then go reissue that bond at a lower interest rate. And so again, average effective duration is really the measurement of the portfolio's interest rate sensitivity. The other way I like to think about it, something I mentioned before, kind of how long of that average maturity length it takes for you to get compensated for your time having been there. So if you have an average effective maturity of 10 years, but your duration is 7, by the time you've hit 7 years, you've probably been paid enough interest that it pays you for your time having been there and kind of almost pays you back the money that you've put in on a relative basis. But the most simple way that we use it in our practice is to look at how much risk you have to when interest rates change. And the thing that was really important about that was when we saw long-term bonds really just hit the floor when interest rates kept getting raised and raised and raised, and we thought it would never end. So those long-term bonds just lost value and lost value, because who's going to want to get 2% for 30 years when I can go get a 1 year for 5? It just doesn't make any sense. So those values tend to adjust to match the market. Again, we talked about some credit rating, super simple stuff. Investment grade up above and high yield or junk below. And these are ratings where you can have a rating of a company, but for the most part when we're looking at these ratings, we're looking at their creditworthiness in respect to a particular debt instrument. So if you have, let's say, a company that issues some secured loans, we like to stay mostly invested all the way up here in all of our debt securities. And if you've got a lot of bonds, you can sprinkle in maybe 1% or 2 down here to just add a little bit of extra interest rate on top of what you're already getting.
Do you have a way to predict the Fed? Because I bought some intermediate term treasuries and they're down 1%.
Right. I wish I had a way to predict the Fed, because that would give me a really, really easy way to add a ton of alpha. That'd be super helpful. But
most people in our business wouldn't admit that, but then again, rates could fall, or at least this is a long-term position.
yeah, well, who knows? Maybe one of these days I'll get Jerome Powell's cell phone number, and then we can have some good chats beforehand. So we just went over today. We went over all the risk tolerance and objectives that you might be following. We learned the different definitions of different risk tolerance levels and investment objectives, how they might fit within you, what they actually mean, and we saw how we could align our portfolio allocations with an investor's needs, even when special circumstances arise. So really all that simplifying down that we did today kind of, again, gives you a baseline to start from, and then you can kind of look at your portfolio, evaluate how much risk you're taking, and then sort of walk back to those more advanced metrics that we talked about before, that we just recapped, and use those to give you a really well diversified, managed, and inexpensive, well-suited portfolio for your needs. So again, all these things are really important to have together, because a lot of times people will just think they just pick a asset allocation and they're good to go, and then that'll service their needs through all the time. But it's really important to look at your special circumstances, look at what you're actually trying to use the portfolio for, look at your personal risk level, your emotional risk tolerance, how much you're actually willing to feel, and see how all of that comes together in the equation to give you the idea of what you should be invested in. So with all of that, I know that was a lot. There's a lot of information in all of this stuff. So, do we have any questions? Anything you want to clarify or maybe get